Is index investing the easy million? Index investing is a passive investment technique that aims to generate returns similar to a broad market index. Investors can use this buy and hold strategy to replicate the performance of a specific index by purchasing the component securities of the index, or by investing in an index mutual fund or an exchange-traded fund (ETF) that closely tracks the underlying index. The most popular index is the S&P 500, which tracks the 500 largest profitable companies in the United States. By investing in an S&P 500 index fund, you essentially own a small piece of each of these companies. This approach offers diversification by spreading risk across a broad segment of the market and provides exposure to various industries and sectors. This allows you to capitalize on the overall growth of the U.S. economy, reflecting a wide array of market activities, from technology giants to healthcare leaders. This investment strategy enables you to follow the index passively without having to pick individual companies to invest in. In other words, you don't have to search for the needle in the haystack. You just buy the whole haystack. Over time, the index is rebalanced as new successful companies are included and underperforming ones are removed. This means your investment portfolio evolves alongside the market, continually reflecting the health and dynamism of the overall economy. Furthermore, because index investing is inherently passive, it often comes with lower management fees and expense ratios compared to actively managed funds. The simplicity of tracking the market without the need for a portfolio manager allows providers to maintain modest fees, making it a cost-effective option for long-term investors. The S&P 500 index has historically delivered impressive average annual returns of around 10%. This means that if you were to invest $500 at the end of each month over a 30-year period, your investment could potentially grow to over $1 million, making it the easy million. This demonstrates the power of compound interest and the effectiveness of a disciplined, consistent investment strategy. Unsurprisingly, if you invest more or for a longer period of time, it can grow even further beyond that. While this approach is likely one of the best ways to build financial wealth, it is harder than you might think. First of all, a 30-year investment horizon is a significant period of time. Over such an extended period, various unforeseen events can arise, potentially making it difficult to remain committed to your investment plan or consistently contribute to your index fund each month. You might find yourself needing funds for major life events, such as purchasing a new home or car, paying for your children's education, or addressing other personal financial needs. This can make it difficult to stay invested or contribute $500 monthly. Secondly, the impact of inflation will erode your results, as the $1 million won't have the same value after 30 years. Have you ever heard an old man in a grocery store say, "Everything is always getting more expensive"? He is right. Over time, everything gets more expensive due to inflation. This means that if you are investing in an index fund to buy your $1 million dream house over 30 years, your dream house might now be worth $2 million. Thirdly, while it is possible to invest in a fund that closely tracks an index, it is not possible to invest directly in the index itself. This means that commissions and fees will always affect your investment results. If the broker or platform that you invest through handles trading commissions on each monthly investment, this could reduce the amount being invested each month, thereby enriching your broker instead of yourself. No wonder they promote it, isn't it? Additionally, while the market has had an average return of 10%, this has never been consistent. This means you need to be able to handle market volatility and significant downturns that will occur during the 30-year period. If we look back at historical returns, there have been times when the market went really negative, with the longest period being 4 years during 1929 to 1932. There have also been a lot of intra-year declines that were even lower, even in a positive year. Are you sure you can stay invested in those negative years and contribute monthly when you see no returns and the value of your investments diminish? People say they can and will, but in reality, it's hard to do. Lastly, it's important to remember that past performance is not a guarantee of future results. To conclude, consistently investing in a broad index fund is a good way to accumulate wealth. However, it's just not as easy as some people make it seem. If making $1 million were easy, everybody would do it. It requires hard work and dedication to achieve success. If you like these kinds of videos and are willing to learn more about investing, feel free to check out Wick Academy's investment training by clicking on the first link in the description below. That's all for now. Please leave a like and subscribe to the channel for more.